Wait, I don't know if I'm. Give me a second here. All right. This is being recorded, you guys, and I mention it at the beginning of every single webinar like a broken record because I absolutely believe that you should watch this again, especially because this is going to be a little bit highbrow, like I mentioned in the beginning, where there's a lot of things going on here. Now, I'm also assuming you guys have been here and watching some of my previous webinars, so my rules will still apply when we're creating different strategies for trying to do a pairs trade. And a pairs trade is simply you're taking advantage of markets that are normally correlated that might become disconnected in a sense. All right. And we're seeing a lot of that go on in the markets right now with the whole coronavirus and things of that nature, where the markets we've seen some stocks do really well in this environment and some of them that aren't doing so well. Now, we might say some of those that aren't doing very well are going to continue to not do very well. But there's some, like, for instance, IBM and XLK, because that's one of the ones that I kind of was looking at earlier. There's a big divergence there, and we might be able to take advantage of something there. So ETF's one with the weaker or stronger components of that ETF. Yes, absolutely. Well, and we can even use ones that are correlated, and I'll talk about that here as well, where there's stocks out there, believe it or not, that are highly correlated that you wouldn't ever really imagine, and we'll go over that here too. Forex currencies for pair trades. You could do this probably with Forex currencies. I don't usually trade Forex, though. All right. All right. So anyway, so the pairs trade here. Let me get a couple of things out of the way real quick. I'm Eric Wilkinson. You may recognize me from mainstream media, where I've talked about everything from economic and geopolitical environments and how that affects the overall markets. I started trading in college with some money I'd earned and moved to Chicago after graduating with a finance degree and started trading on the floor of the Board of Trade. I started out as a runner, as most people do, and then moved up into the pits. And in that entire time, I've been trading my own money. So I've survived, and my staying mechanical is what really does it. And it's not like I'm trying to go out there and swing for home runs, you guys. I like to hit for singles, doubles, and triples. I like to try and stay safe out there in all of this craziness. And that's how if you want longevity, that is really the way to do it, rather than trying to go out there and follow somebody's 10,000% gain. All right, so you can follow me on Twitter at Wolfman's blog, or our parent company at ProTrader Strat. Also, we throw out a lot of content on our Facebook page, so please follow us at ProTraderStrategies.com there, and you'll get access to that information. We also have to go over this disclaimer here, and it basically says any opinions, news, research, and analysis should not be constituted as investment advice or solicitation to buy or sell any of these securities strategies we're talking about. We are really here to teach you guys, not try to give you guys investment advice. I don't believe in that because I don't know your risk parameters. I don't know what's in your portfolios. So make sure you take this all into account in accordance to your own risk parameters. All right. Beauty in this is it's highly probable strategies that we've created, right, through some of my mechanics that we've talked about in the option strategies webinars. Well, we're going to be combining a lot of those in this. And when you have these stocks that are highly correlated, that have kind of gotten away from one another, coming back into line is really probable. So we're going to be trying to take advantage of that. All right. So like I said, we're going to be trying to profit from that divergence in correlated underlyings. You guys might be thinking, how do I know if it's correlated or not? Well, I've got a couple of little tricks that we can kind of find it out. And you might want to be having a market neutral assumption. You could do that as well. All right. That's how you could do it. I usually look at this where they've gotten out of line, maybe flipped, gotten inverse, and you're going to be able to take advantage of it. Like John mentioned, that maybe you got an ETF with a high correlation to an underlying, and all of a sudden you're seeing this big separation. Well, that might very well be the time to take advantage of something like that. So we want highly correlated with a divergence. How do we know if it is? Well, we can check out this website, right? So you guys can jot this website down while I pull it up. And that's this website, so you can still see it up here in the URL there. All right. What it does is it allows you to build out this matrix, all right? And the matrix tells you anything basically above, I would say 70, I think is what it says. I like to look in the 80 pluses, but you can see that I can't get this thing to scroll down earlier today. It was giving me fits on jumping too far. Let's do that. There. All right. So you can see like Apple correlated to Best Buy. Who would have thought? Well, I mean, I guess you could think that they sell a lot of apples, but how about CVS? I mean, that's a highly correlated stock. Home Depot, they don't sell Apple, but they're correlated, all right? And those are ways to figure out whether there's correlations. And you can find that if there's very uncorrelated, right? So if they're running in tandem and they're very uncorrelated, you can take advantage of that as well. I usually just go with the correlated ones that are really separating. IBM and MetLife, you know, who would have thought that those two are correlated? So you can always find those different correlations through this matrix, and you can build it out yourself for the stocks that you guys like to look at. One thing with this website is they are always trying to get you to upgrade, but they do give you a couple free matchups and stuff like that per day that you can take advantage of. So this is a good website for that. It's the only real thing I use this website for, to be honest. You can really do, it's pretty in depth for all of the things that you can try and figure out with it. But, you know, you would think that IBM and maybe Intel would be a little bit more correlated than what it is, but still highly correlated in regards to that. So IBM and American, or Alcoa, I mean, they're highly correlated. Not so much with Intel. So you can use this website to find those kind of things. We'll bring that website back up here in a minute, but we want to find some that are highly correlated. How do you know if they're highly correlated and they then have a divergence? Well, you can also build it out on a chart like this. So basically you go up into here and you just type in comparison, at least on my platform, type in comparison, throw that over there. It's going to default to SPY or SPX. Here, I'll just throw it up there. I'll cancel it out for a second. We can throw it. I want to get rid of you. Add this to the side over here. It gives me SPX. So one thing we can do is go in and change this by just hitting that gear, go in, and like I had it with is IBM, because IBM is cloud-based and it's kind of been lagging on the whole rally here. So I think that it's due for a rally. So I was trying to find some things, you know, based on my assumption, and I threw in Intel against it on this particular chart. So that's one way to come up with the divergence. Somebody was asking, how do you figure that out? Strike location is going to be huge. We're going to be looking at, if you're looking at undefined and you have high volatility, right? Well, you're going to be looking at that 16 delta that we talked about, selling a 16 delta call or put, depending on if you think it's bullish or bearish, and if you think that it's going to be a defined risk strategy on the short side where you're trying to collect credit, you're going to be creating that short call spread at that 35, 36 delta, right? Just like we talked about the short call spread, short put spread. You could also do this with synthetic longs, synthetic shorts as well, like we've done in these webinars, right, on implementing options into our portfolio. All of those rules will still apply while building this out, right? If you're doing it as a pairs trade, you're doing a long call spread against a short call spread and another one, then you're going to be using different months. You know, we're still following those rules, okay? I'm not going to go over every single rule for every single strategy. So I'm kind of assuming you guys have been playing along a little bit here. I will mention some of them, that when we're building it out, that it's following my rules. But we're going to try to follow that as closely as possible to take advantage of it. But keep in mind, we'll be trying to keep you guys in the loop on that. There's a lot that goes into figuring out the correlations and stuff like that I'm going to be spending more time on with this one. But all the rules still apply for strike location on this and the correct environment, right? We need to know our environments for each individual underlying. High implied volatility percent, well, that is going to be selling premium. Low volatility, we're going to be looking to be buying premium. And we're still going to have to worry about our duration, right? We're going to want to make sure that if we're selling call spreads, we're taking advantage of the duration inside of that 35 days to expiration. If we're selling a call spread and high implied volatility, can we send that link over for? I think that yeah. Give me a second. I'll throw it in the. I'll try and send it out to everybody here in just a second. And then, if we're trying to take advantage of a long call spread, we want to get out here in this area, right? So let me see if I can pull up this and throw it into the window. So paste. I'm going to see if I can send it to everybody. Did everybody get that? It said send to all, but I don't think it looked like it sent to everybody. Looks like it just sent it to Faye, and Faye didn't even ask about it. All right. Let's see. Paste, and how do I send it to everybody? Did everybody get that link? Ahmad, did you say you got it? All right. Everybody got it? Okay. All right. Perfect. All right. Sounds good. So that's the link that if you guys want to pull that up, but not a good clickable. Oh, sorry. That's not my fault. That's GoToWebinar. I didn't design this platform. I can throw it out in the chat window. And here, go over to the chat window if you guys are having trouble with that. I'm sending it out to everybody there. So that should be a pop-up easy. Let me know if that works for you, Chris or Peter. It's over in the chat window. There you go. All right, good. So like this, I think is their default. I have played around with it, but I pulled this up a little bit late today while trying to do this. A lot of times I will go over to this platform. I switch the style over to the chart, which is just a line graph. All right. I go to the line, and then the one that is purple, it's a little bit more confusing, but if you guys are using Thinkorswim, for instance, the purple is the default that I made it, right? And its price is over here, all right? So IBM is obviously not trading 46 or 47. It's over here. So when you're lining it up, you can see what the prices is. If you're trying to figure out strike location by the chart or whatever, you need to look across. The Intel line is to the right, which you're probably normally accustomed to. One thing I was talking about with this is, IBM has been generally kicking Intel's butt on the charts, being above, right? And we would expect if everybody's working from home, cloud, if you guys watch the daily market commentary, it drives me nuts. Nobody likes IBM anymore because they've gotten away from service and now they're doing cloud. Well, this is the perfect environment for them with all this cloud. It's, I can go on and on about that. So again, I'm stuck in this conundrum of why is IBM not benefiting from all of this in-home stuff, and I think it will. So I think Intel, obviously has taken advantage of it. People have noticed that. Well, it's not to say that Intel is not going to continue higher, but I think that IBM will likely catch up with it. And if this is something that's going to happen, I think that we will probably see a little bit more weakness in Intel, or it's going to struggle at least a little bit more in the interim. And IBM will try and catch up with it. Faye, give me a second. We'll do that. Look at AMD versus Intel. We can do that. I'll just change the IBM default real quick. We'll move over here so you guys get a chance to see this. AMD. Okay, apply, okay. And yes, they are highly correlated. Usually Intel is above and AMD is below. And it has moved above there, right? So one would think that maybe Intel is due to at least rally against AMD, or AMD is going to continue a faster sell-off than what Intel can gain on it, right? However you come up with your theory. To me, that one's a little bit close. I mean, obviously, when AMD gets like slammed and Intel was rallying, that's the time to come back into correlation. But, this is a little bit tight. But, if your assumption is that Intel is going to go back above, then absolutely. And we can take a look at that when we start playing around with the charts a little bit more as we go along here. So we want to take advantage of, if you're putting call spread, a long call spread, short call spread together, make sure you're still trying to take advantage of those rules that we have for those specific, call spread, short call spread, long call spread. Follow those rules still. I understand the correlation, but how do you go about setting up a trade on the platform? Absolutely. We're going to do that here in a minute. I just want to make sure that everybody's pretty, there's some important stuff here, and then we'll start playing. All right, position size. I usually talk about this as we don't want to risk any more than like 2 to 4% of our overall portfolio on this. This is really an engagement tool. You're putting in a theory there. But the problem with this is, one problem with a pairs trade, you guys, whenever you're trying to pit two stocks against one another, well, you could lose on both of these strategies if you are completely wrong with your market assumption, okay? So keep that in mind, that you are kind of doubling up on a position here. But the nice thing is, when you're right, you're getting paid off handsomely for it. So play it small. You're trying to keep engaged. You're playing a theory that you have based on coming up with something. And there's always opportunities out there. And I would always say, never be like a one-trick pony. This is, every once in a while, you need to say, I need to look at some pairs trades and implement that into my portfolio to create a little bit more diversification and or hedge something. If you have American Airlines in your portfolio, or Disney or something like that, and those aren't working out very well, you can throw in some pairs trades to start trading against that and maybe help out that position a little bit. All right, our exit. Now, if we're in this trade for 5 days and we have a 15% max profit, that's probably where we should start thinking, less than, if we're in this, I should say less than 5 days. So, less than days. Keep that in mind. I don't want to, like I said, I'm not swinging for home runs here, you guys. I never am. But if you can get out at a 50% of max profit, that's usually where I am going to pull the ripcord on it. All right. So there must be divergence with high correlation. Yes, generally that a must is a pretty strong word, but yes, you want to see something where they have had a nice correlation, and all of a sudden they kind of break out a line. So, one of the things we could do is find that one. This is what I want. Find this one. We've got like Intel, and we could look at Best Buy. So let's pull up. Actually, let's go back to Phase real quick, just because that's the one that we had up there. So what's our assumption here? Is our assumption that Intel should gain on AMD, let's just take a look at AMD here and just see what it looks like on a normal chart. AMD, make sure they don't have any earnings. Okay. So AMD looks like they, how do you manage should the trade go wrong? Well, I'm going to usually do this with defined risk strategies. All right. And the getting out of these strategies, it's really still going to be following along with my my rules for know your exit strategy when you're entering a trade. So for instance, if it's a defined risk strategy on a short call spread or a long call spread, I'm usually going to let the probabilities play out on that. If you're doing it as a naked short call and a naked short put, and you're looking at like that 16 delta, then we could be talking about when that comes down and hits my strike or breaches my break even on that that strike. So I'm short the 16 delta calls, let's say, and it goes up and goes through my 16 delta calls as that break even gets out. All right. Now, if you're doing this based on a chart setup, for instance, here with Intel or AMD, you know, and I was wanting to short AMD against this, my out would probably be, if I was thinking AMD was going to go down, my out would probably be if it hit this 52-week high, right? So whatever you generally use, you know, like if you're using Fibonacci, right? And you're saying support and resistance is here and there. Well, if you see where there's a line in the sand that you would want to get out, then I would still stick with that rule, okay? I'm not here to tell you to change how you got into the trade, but how you usually, what I say is if you're getting into a trade, know where your exit is before you're entering that trade. And for me, if I was looking at this and saying I was going to want to short AMD and get long Intel, well, I'm sure I'm getting out of AMD if it's breaking above 70. As a matter of fact, if I was looking at this trade, I would probably say if it's getting above 68, I'm probably going to get out because, you know, it looks like it bumped up against here a couple of times. That would probably be where I'm looking to get out, or actually not 68. AMD is across the way, Eric. 57. If it got above 57 or above, you know, 59, probably 59 is where I would say on this one. If AMD started trading 59, because remember we got to look over here on this side for this, right? AMD starts trading around 59. That's probably where I'm getting out of that one. You know, and if Intel is working out and starting to rally, then I wouldn't worry about it. But if Intel broke below 57 or something like that, then that's where I would get out. You know, and you can throw up your Fibonacci's and stuff like that as well. Okay. On a call, but if you're doing call spreads, short call spreads, or long call spreads, that's defined risk. And my rule for those is just kind of let those play out because you know your risk getting into it. And stick with that. You know, if you're doing synthetic longs and synthetic shorts, you're definitely gonna, you know, maybe want to pull up a Fibonacci, and those are pretty close being lows on the Fibonacci. So I'm just gonna say their Fibonacci's are pretty tight. So obviously, you know, we can line this up above 59 for AMD, and if Intel started breaking below 55 is where I would look to get out of that one. Okay. Does that answer your question, Chris? I don't want to tell you where I think you guys should, right? I'm just trying to give you guys different trade ideas based on high probability setups, right? And some of that does have to do with getting out of that. And, you know, when we're getting out of defined risk, I like to stick with the defined risk. And if it's a naked strategy like a synthetic long or synthetic short, then obviously what I would do is, for me, the Intel starts breaking below this 55 area. That's where I'm getting out of an Intel long, and an AMD short I would be looking to get out at on a loser above 70. I'd say actually above that 60, 68.50 is where, or that's not 68.50 on the AMD above AMD above AMD of 59. If I go over here, if AMD breaks above 59, I'm out. If Intel breaks below 55, I'm out. All right. That's kind of what I'm thinking there. Okay. So now the other thing we need to do is kind of go over and look at the platform and see how we would set this, what's the best strategy for it, I did draw the Fibonacci on AMD. Yes, I did. The reason why I drew that Fibonacci on AMD in that case was because this chart is set up, pretty close to, it would be confusing if I, whoops, I don't want to do that. It would be confusing if I drew two Fibonacci's on this one chart because they're so closely correlated, right? I mean, I could go and throw one up on the Intel one, but look, I mean, the lines in the sand aren't too far off, right? So that's why I just drew one. Because I knew they'd be pretty close. Are you using strict dollar or are you using delta percent? I'm using delta percent if you're asking about when I'm talking about like selling a 16 delta, right? So for instance, let's look over here at, it was AMD. Let's look at AMD. We can see, when we're looking at implied volatility percent here, it's pretty strange in these days and age where we have really high implied volatility. Do we think we're going to get this happening again? We could, but what's the idea here is we're thinking, is this volatility going to continue to come out? I'd say it's almost neutral. So neutral to being low for what we've got going on right now. So with advanced micro device, I'd probably be looking to say, I'm going to play this to the upside. The other thing is we can also play it against what we were talking about because we are pretty much having offsetting implied volatilities, right? So these are pretty correlated assets, generally speaking. So volatility is generally going to come into both of them and exit both of them at the same time. So another thing we could look at is, if we believe that the volatility is going to start rising, we could, or we're unsure. If you're just completely unsure, middle of the road, you can play it against each other where one, you sell a call spread and the other one, you buy a call spread, right? And the idea being that volatility is going to kind of offset those two sides, right? Our long call spread will gain in value by the volatility expansion, while our short call spread would be hurt by that volatility expansion, right? So, it is a pairs trade. So the idea is we're trying to hedge each other on those. And that would be a way to, if it was middle of the road, just like what we're looking at with Intel and AMD, advanced micro device, that we could say that, in Intel, I think volatility might start going down, right? So that's probably the one where if my idea is, generally speaking, when the market goes down, volatility goes up, right? So if my idea was that AMD is going to go down, that's the one I'm thinking is probably going to start seeing more volatility. So that would probably be the one where if I'm playing it to the downside, I might buy a put spread, because when you buy a put spread, remember our rules is that's where we want volatility to expand. And in Intel, I might sell a put spread because I think that it has high implied volatility and that volatility is going to come out of it. And therefore, I make money on the way up, right? So, and those different volatilities could offset one another if it started expanding. It's not a perfect world like we can talk about with just one strategy, okay? One strategy. There's a lot of things, levers and pulleys, even more so than what's normally seen. So keep that in mind. Peter's saying, are we considering this to not have enough divergence? I would say it's not. You know, obviously, hindsight being 2020, I'd like to see it when it's wider. And that's what I said at the very beginning when we came up with this example. It seems like it's a little bit tight. So let's look at my other example real quick. So I'm going to look at, come on now. I want to look at IBM against XLK. IBM, or you know what? I'll throw XLK in here because you guys can throw out some other stocks that are in this technology, because the technology has been a little wanky, right? I mean, it's been the one that's, you know, like NASDAQ has rallied, and you can see that this one, you know, these are places where you would want to put these on where they start getting really out of line. But Intel is very correlated to XLK, which is the technology ETF, right? Well, that makes sense. They should be kind of. But IBM, on the other hand, we look at IBM versus XLK and look at the difference here. This is one of those situations where it's gotten really wide. Not only has it gotten wide, where IBM's dragging, but look what else has happened. I mean, it kind of happened before the coronavirus, but IBM has been dragging against it. You know, it's kind of lost ground, and now it's really lost ground. And like I said, my feeling is the cloud is doing very well, and IBM has been changing over their business structure to be more correlated to the cloud and less service sector, which, you know, investors don't like for some reason. It's big blue, but I think it's a good thing for them, and they'll benefit much better in this type of environment. So I think that IBM is due to rally against the rest of them. And if you guys watch the daily market commentaries, I've been talking about these sector rotations we're starting to see here. And some of these technology companies have had a great couple of months, right? And it makes sense that there's people that got in on those lows, like myself, in a lot of these technology ones, because I was like, hey, the people are going to be building out their home computers and their home theater or whatever, their home offices. Therefore, these technologies are really going to do well. Well, now people like myself are even thinking, all right, I've done very well with these. Yes, they have some more room to the upside, but let's start reallocating to these sector or these companies that haven't done so well, right? So I think that a lot of even money managers are probably thinking the same thing. All right, so there is my thought process there. And they are, Ahmad is saying that they are an 85% correlation. Yes. Ahmad, I will check your BMW in a minute and versus Microsoft. I'm trying to read another one. I was late, but do you look at OBOS? Can you expand on that, Benu? Did I get that right? Different vols would offset. AMD expected to fall with volatility expanding and Intel going up and volatility falling. Can sell a put spread in Intel and buy a put spread. Now, well, I would want to, if I thought that AMD was expected to fall and have volatility expand, John, I would want to, when you're buying a spread, remember, we want volatility to expand, hopefully. So if I was buying a put spread in AMD based on it falling, I would probably want volatility to go higher. All right. And if I was selling if I was buying a put spread in AMD, I would want the volatility to go higher. And if I was selling the put spread in Intel based on the fact that I thought it was going to go up, then I would want the volatility there to go down. And that's intuitive of what I was saying. If markets, generally speaking, it doesn't always happen, but we know that when volatility expands, it's usually because people are buying puts. And that's when the markets, they're worried about the downside, right? So when the market starts coming down, we see volatility expand. So if I was expecting AMD to come down, I would expect the rest of my theories to kind of follow through with that. All right. Overbought, oversold. Okay, so I was late. Are you looking at overbought, oversold? Yes. Overbought, like here in this regard, I think that XLK is overbought in relation to IBM. You know, it doesn't always have to be overbought versus oversold. It's just like, you know, I'm looking at IBM usually doing very well against XLK, and just recently that whole correlation has switched. Now, is it going to stay that way forever? Maybe a little, but look, IBM is really getting beat up compared to it, right? I mean, as a matter of fact, you could almost say that XLK is continuing to go higher while IBM is continuing to go down in a sense. So I expect that whole thing to flip. All right. So I expect, you know, XLK, do I think it's going to go to the 52-week highs, you know, in the next month or so? Probably not. Because again, I think that people are saying, yes, I do think that going forward, these companies are going to do very well, but are my expectations of them doing as well as before this whole thing hit the fan? I mean, I struggle even with that thought, because there's stuff in XLK that is not going to do well. And do I think that IBM is, you know, the ugly stepchild or something like that? I don't know. That's probably not politically correct anymore, but, you know, it is. It feels like it's the one that gets neglected. And are people going to start going into more of the blue chip stocks? Well, IBM's considered a blue chip stock, and I think should do very well in this thing. So that's how I'm coming up. You know, however you guys come up with your theories, right? And I'm not expecting you guys to jump on the bandwagon with me on this this thought process. I'm just going through what you and I all go through on a daily basis, right? We go through this every day. We see a TV commercial and think, oh my God, that's the next greatest product or whatever, you know? Or, you know, I don't know if you guys watching the daily market commentaries, when all of this stuff hit the fan and all of a sudden the airlines are going down, and I'm like, who wants to go to an Airbnb? Who wants to go on an airplane? Who wants to go out and buy an RV or a pop-up? Me, right? That's what I would rather do. I guess I'm going to have a great argument for my family that we're going to start camping, because do you guys really want to go into one of these places right now? Probably not. And I'm telling you, RVs sales are going through the roof. As a matter of fact, I just talked to somebody who's been trying to buy one for about a month now, and she's like, every time one comes on the market, and she wants to buy a used one, but she's like, every time it pops up, we can't get there fast enough to buy it. So she actually told me today that she ended up getting one, but I've been keeping an eye on it. She said she's been chasing them forever. And as a matter of fact, she sold her old one for, and it was a really old one. I don't know the exact date of it, but, and I don't know the exact numbers, but let's just say she bought it for like $7,000 and she sold it 4 years later for like $9,000. She made $2,000 on it. And that's unheard of. That is unheard of in pull behinds. Usually people are paying through the nose for those, and the devaluation on those things is worse than a car. All right, so enough of that. But that was one of those things that I took advantage of. I ended up buying Thor on the bottom there. But that's not here nor there. So let's take a look at IBM. I think IBM is going to go higher. We could look at IBM for its implied volatility. IBM, and it's got a pretty low implied volatility percent. And usually with trades, right, I talk about IBM is the grandpa and XLK is the wild child. That's very well true, but IBM's in there, and I think it's actually a pretty, decent percentage of it, right? Last I checked, but I will admit I haven't checked for that in, some, 8-9 months. So I don't know. It could have gotten its allocation a little bit different. But in historical terms, IBM's pretty high, but I do believe IBM is probably going to rally and it's going to lose more volatility. We don't have anything to worry about with earnings because they just had those. And then I would look at something like the XLK. If we look at XLK and what's its volatility, XLK, it's got its volatilities 26 or something, 30. So what's my rule for an ETF for premium selling strategies? Anything above 30 is pretty okay to sell premiums in an ETF. So this works pretty good with my theory here, right? I expect XLK to at least struggle. It might cover this little gap, but it's pretty close. I think it's going to go to this all-time high. I don't think so. That would probably be where I would look to want to be out of it, though. So I want to play this to at least slow on this ascent, maybe a bit of a correction. I'm only looking to make a quick hit on this. I think that this is going to correct a little bit while IBM, gets a longer term trend to the upside, right? Because it should be performing, at least get back to the point of control there. So in a sense, what I'm going to be looking to do is building out a strategy. If I'm trying to take advantage of volatility expanding, I want to go out on that time horizon that we looked at, right? Where I was looking at this chart here. We don't need to see this anymore for the correlation anymore, right? So if I'm buying a strategy, this is where, we buy spreads, and this is where we short spreads inside of this area, right? So I want to take advantage of it out here. About that 70 days is kind of what we're looking at here with the August, 80 days, actually, sorry. So I want to take advantage of IBM moving to the upside, all right? So I'm going to be, and my rules for a call spread, usually we talk about going in the monies here, all right? Which for a call spread in this regard, I'm going to be looking to lay out a little bit less here. So I'm going to go to the 50-50 to the upside. So I'm going to buy this one and go probably, I'm just going to go $5 out. Yeah, I'm going to go $5 out just to start. So I'm $5 wide, $2.70 debit. It is a little bit rich. I'd like to go 50-50 on this trade on the IBM. So let's take a look at buying the 130s and selling the 135s. See if I can get to 50-50. That's much better than 50-50, but my probabilities aren't that good. I'm going to stick with the buying this one, selling that one. All right, so we've got that one. Let's see if I can get this. I used to be able to do it, but I was having trouble getting this to work out for me. And now XLK, I think, is the short end of the aspect. So I'm going to look to try and build this out $5 wide and collect my probably about $1.30 something credit. So I'm going to go to the hundreds and sell that one. This is going to be really close to my rules on selling a call spread. It didn't keep that up. Why won't it do it anymore when I try to do that? $1.70. So that's something I would like to do. Selling a call spread is according to my rules, right? I'm looking at that 36-ish delta. Collecting $1.70 is more than that's probably 34% the width of the spread. So let's see if we can go a little bit less risk and go $5 wide, $1.27. That one's going to be close. So how do we figure it out to see if it's 25 to 35% the width of the spread, right? That's our collection rule for selling a call spread. I'm going to go 127 divided by $5 wide. So it's 25%. So my rule for selling a call spread, right, is collecting 25% the width of the spread on a short call spread or a short put spread. But in this case, we're doing a call spread. So I would try to do that one. And then on the IBM one, look for that call spread that we had up there, which was the IBM. And looking at, 35. Oh, wait, XLK. What am I doing that in? July. Yeah, July. I'm doing the July for XLK, right? Because I want to take advantage of theta decay, right? So short call spread closest to 35 days to expiration. You could even go a little bit closer on the June and do it that way. I'm doing it because I'm doing a short call spread and a long call spread that I want this pairs trade to have some time to work out. So I'm doing it that way just for that reason. And then I did this one. So I want you to work for me. I can't remember. There might be a way to do this. Buying that one, it's not letting me do the build the pairs trade that way anymore. And then building this out. So I ultimately end up doing this, pairs trade for about $1 debit, right? Because I got the $1.70 credit and the other one paying $2.70 debit here. So, ultimately I'm not laying out a whole lot of money. Now, keep in mind that I could lose on the IBM trade. It goes against me. I lose the 270 debit and the other XLK could rally and I could lose on that. Why? That's why I'm saying, do this for a much smaller tranche than what you're normal to, right? I would probably be doing this, a couple of maybe 1 or 2 lots or something like that, right? Don't go big on this. Can you pick the pairs trade on the trading menu at the top? Is that where? I'm not sure where you're saying. What's the rationale of using the 36 delta? The 36 delta on shorting, because that usually is where we start out. Remember when we did the short call spread and the short put spreads, that I usually looked at that 36 delta. That's a half a standard deviation move. So that gives me the third, collecting a third the width of the strikes on the strategy. It's only a 36% probability that I'm wrong then. And then the reason why I'm doing the IBM as buying this call, the 125s, I'm bullish. So I'm buying it at a 50 delta. So I've got a pretty good probability of success of at least staying right here, or it being in the money at expiration a little bit. The spread is way too wide in IBM. What do you mean? For the bid offer, you're right. Rudy, if you've been watching my, I didn't notice that, but that it is out there for that spread. But I'm pretty confident that with the maybe, start out at then that was pretty wide. So that's probably why it's not working out to the 50-50 rule where I'm saying risk one to make one. Start out at the 250 and maybe just ratchet it up a little bit because it should be a little bit tighter in there. It's way out in time, but my rule for this, right, it's not working out here either. And it could be because it's after the close, you guys. Remember, all our orders got canceled, especially with Trump's tweet that I didn't even get to see. Is that you move the decimal 3 ticks to the left, that should be about 12 cents wide. You can see that these aren't quite fitting that rule. It should be, 12 cents wide to bid offer. Some of them are, but yeah, it's not really. A little wide. So it'd be a yellow light. you know, we checked the width of the spreads over here. So it's pretty close though. Yeah, Faye's saying you're right. You're right, Faye. Like think about it. If I had this order in as a day trade, it got canceled as soon as the market closed. So it's not being represented in the markets anymore. So especially recently, you know, back in the day, like last year, you know, that this would still fit that rule because people would be leaving orders in all the time. They didn't really cancel as often as they are now, but now nobody wants to leave anything overnight, and especially over the weekend. So not that we have a weekend tomorrow, but over the weekends you see these really get wide. So check, you know, the spot month, which this is still pretty much a spot month. Check the rule. If it's over $100, move the decimal 3 ticks to the left. Check the bid offer. You will see that, you know, that these markets out here will get wider. And my August, which is 80 some days out, is even wider yet. You know, one thing to do is just kind of double check it. Volume and open interest. You can see there's pretty decent open interest. They've had good volume. But know that when you go really far out away from the spot month, these do get wide. But there are tighter markets in here you're not seeing, right? Because see all of these different HQ, C, QH, there's W's and I's and stuff like that, XZ. Those are different exchanges. There's so many exchanges, and this compiles all the exchanges. Well, if I have a spread on a calendar spread, you know, I might be on the C exchange, but X is the bid and stuff like that. These algorithms now will auto leg stuff, but they can't really represent an order visibly. That's not a sure thing. So there's tighter markets in here, and yes, that is pretty wide. So start out with my rule, you know, 50% the width of the spread, and then kind of ratchet it up from there. I see a couple of the questions. You keep the spread the same in case the $5 on both spreads. That's what I try to do. Yes, Peter. And you know, so for instance, if I was doing a $100 stock against a $50 stock, you know, in that case, this being, you know, the say $120 stock against a $60 stock, just for easy math, then I would also probably look at doing this as a 1 lot and the other one as a 2 lot. All right. And my $60 stock is probably going to only be about $3 wide, or maybe even the $250 wide. All right. So 16 delta is the 1 standard deviation, 36 delta is a half standard deviation. Correct. And, you know, if my assumptions were still the same with IBM versus XLK, but IBM had the high implied volatility and XLK had the low implied volatility, well, we would probably be doing this completely opposite, right? Where we would be looking at put spreads rather than call spreads, right? So that whole dynamic is the same. Now, if you have a higher risk tolerance also, then, you know, we would be looking at maybe doing just buying the long call in IBM and selling a short put in XLK. In that case, you know, we'd be looking at the 16 delta short call in XLK and, you know, probably just buying the naked call here in IBM. So. 36 delta would be getting half the width of the spreads. What? 36 delta will not usually, it'll usually be about, you'd be paying a debit of about a third width of the spreads on a long call spread. On a short call spread, 36 delta will usually get you a collection of that. All right. Sorry about the dogs, you guys. Eldon, Wrigley, quiet. Leave it. All right. No, I got two mutts from the Maricopa County shelter. They were puppies when we got them. As a matter of fact, Overstock used to have a thing on there where you could find dogs. That's actually where my wife found. Both legs the same, durations different. Both legs the same. These legs were different, in the sense though, where I was buying the 50 delta in the IBM and selling around the 30 some odd delta. And then in XLK, when we looked at XLK, I was selling right around the 38 delta. Actually, I was out further. I was doing the July. I was selling around the, a little bit further out. So it was flipped, right? 34 delta. Dogs keep you sane. Yes, they do. Except for when you're doing a webinar and they're barking at probably one of my kids in the kitchen. And I keep them in here so that they can't hear the doorbell or see a car drive by or a rabbit in the yard or a bobcat in the yard, and they start going crazy, which ends up being worse. So I try to desensitize them a little bit. All right, so takeaways here, use that website if you want to find quick correlations, especially on things that you wouldn't expect to be correlated, because you will find some really interesting, like CVX and IBM are correlated. That's kind of a weird correlation. Chevron and IBM and CVS and IBM. So it's a good way to find things that you wouldn't expect to be correlated. UPS and Sprint, not correlated. I don't like Sprint really because it's such a low dollar stock. I wouldn't probably do a pairs trade on this unless I was just buying the stock outright. But as per your experience, please advise if Thinkorswim includes a good supply and demand study. I don't. I have used Thinkorswim for many years, but I have never looked at a supply demand study. I've never looked at one. Sorry, Ahmad. I would, you know what? They're great. If you call the desk and ask one of those guys have been, a lot of those guys are actually floor traders from back in the day. So they know, they might be able to give you something great on that too. All right. So you guys, this is the offer we're giving you guys. It is a great trading course for $497. You guys are getting all of these different courses where you can trade volatility crush, taking advantage of that. Learning volatility like that with all of these courses, and there's a couple of more there that aren't listed. I just had to squeeze them in here. Will help you sleep at night. This will streamline your process. If you guys are constantly looking and trying to do math in your head or using a calculator and stuff, that this will streamline your process. If you've gotten a little fuzzy on some of my rules for dealing with pairs trade, I know there's a lot of new faces in here for this pairs trade. Go back to this options basics course and learn those rules, because I have specific rules in and around every single trade or every single option strategy that makes it a little bit easier to comprehend, and the reasons why we are using those specific methodologies and rules in and around those, or guidelines, I should say, really. And then how to set your option strategy or option screens up, your trading platform, all of that stuff, according to, like if you want to know more about market profile and how to trade that stuff, or trading gamma and stuff. We talk about all of that in here. So take advantage of that. One other thing we got to talk about here is, well, actually, you know what? I'm going to say thank you guys for taking advantage of this. We are also going to pull this up so I can throw it in the chat window for you. That course is not a hot link there, so I'll copy this. This is the link if you guys are watching it on tape delay. If you're watching it real time, over there in the chat window, I have that link. It's another hot link that you can pop up and take advantage of. But later webinars, I'll drill down on different option components when and where I find those appropriate. Also contact us at 310-598-6677, or if you have an idea of a webinar or something you want us to do something on, give us a call, give us your feedback, and trading at protraderstrategies.com for that. All right, like I said, here's that options course. Take advantage of it. Links in the chat window or right there to punch into your URL. One last thing before I see a couple of other questions coming up. I'll get to those here in a second. Just give me a moment. I got to pull up this compliance letter, which is our disclaimer. Make sure you guys know there are inherent risks in trading. Take a minute to go over that. They're very helpful with when you explain. Wonderful overall. Thank you, Faye. Appreciate that. If you have a minute before you close, could you clarify this? Can you repeat about the short and long spread and 36 deltas and the width of the strikes for a credit and a debit? Yes, I will. All right. Everybody read over all that? Good. So let's go back to the platform real quick. Okay. So here, I don't have a bell curve here, so it's going to make it difficult. Just trying to think through this. All right. So now, John, I know you've been in a couple of these webinars before, right? So, all right, when we were talking about the bell curve, right? So when we're looking at a bell curve and standard deviations, right? So when we talk about those standard deviation curves, we've got a bell curve that looks like this, right? And the idea is right here is at 0. Well, a half a standard deviation to either side there lines up with about a 36% chance, right? 36 and to the put side, so that's like a negative 36% and negative 36%. Well, delta is equivalent to percentages. Yes, natural distributions, right? And when you see a bell curve that kind of looks like, a real squished down one, being the same thing, well, the idea is now that distribution where one standard deviation is out here, right? Well, that's because when volatility comes in, you can think of volatility as a bucket on top of the curve. And when volatility is really high, it squishes down, it puts downward pressure on that and squishes it up. This bucket doesn't have anything in it, so it's like a normal distribution. So probabilities are equivalent to delta, because delta, although it does tell us what delta tells us here, what $1 move in the underlying is going to do to our premiums, right? That's what a lot of people talk about. That's what most people will say. Delta is how it affects the premium of our strike for every dollar move in the underlying, right? So a dollar move higher in XLK from 97.31 to 98.31, the 39 delta goes into this premium over here. So, $1 move higher, this premium is going to go up by 39 cents. $1 move lower, that 39 cents is going to come out of it. Well, this is actually one of those floor trader hacks that will streamline your process. That delta tells us a lot, like 5 different things. Well, delta also is probability. It also tells us at expiration in the next 50 days, this underlying 39, or this strike has a 39% probability of being 1 penny in the money, meaning that 100 call has a 39% probability of being 1 penny in the pit, 1 penny in the money at expiration. So XLK has a 39% chance on July 17th of being 101 cent. All right, that's being in the money at expiration, on the expiration date. Okay, on July 17th, XLK has a 39% chance of being 101 penny. All right, that's not, but it's only a 39% chance of being in the money at expiration. Those are pretty good probabilities. So that's why we'd like to sell, especially if we're bearish. If our assumption is correct, we win double. Selling a call spread, selling that like 36-ish delta, there's only a 36% probability of being in the money at expiration. Those are pretty good odds. And if you're doing this according to my rules and everything else starts working, if volatility came out because we're selling a call spread, that helps us. So we can be directionally wrong and still make money on this trade, right? And at 78%, yes, a 36% probability of being in the money, but a higher probability of being touched. Absolutely. That's why on defined risk strategies, I like to play out the probabilities. So 2 times the delta is the probability during the next 50 days that we will see our strike get kissed or the market come up and touching it, right? It's 2 times the probability. The markets go like this, right? So it hits it, it may hit it, but it's only got, a chance of being in the money at expiration. So, that makes that move. Here's expiration. All right. Well, my strike is right there. Finished out. Now it comes up. Might hit it. Right. My question is on the credit versus the debit spread. Well, the debit spread, if you're doing a debit spread, my rule there for this, when we're buying that at the money one, I want to risk one to make one, especially when you're buying the 50. If you're doing a 50 delta, you should be looking at buying a call spread where you're risking one to make one. 50-50 chance of making, money or not making money. So debit spread in this case, when you're buying that 50 delta, you want to risk one to make one. When you're selling the call spread, we want to risk 2 to make 1. We want to collect a third with the strikes. Why? Why are we? You might be saying, well, why are we risking 2 to make 1? Well, my probabilities are a lot better on the short call spread than my probabilities are on the long put spread. So my probabilities are better of making money on the long call spread, and my probabilities when you sell a call spread, the probabilities of being out of the money are much better. So the idea is you're going to have to risk a little bit more there. My probabilities of being a long call spread, are 50-50 there, right? Of my call being in the money. So it's like I've got to pay up for that because I'm taking a little less risk in a sense, quote unquote, less risk. That answer all your questions there, John? All right. Perfect. All right, you guys, thank you very much. I appreciate all you guys sticking around a little bit longer. Hopefully we cleared everything up for everybody. Check us out on Facebook, like I said, because I talk about the daily market commentaries. I'm going to be looking to maybe do this trade in tomorrow's daily market commentary, depending on what Trump tweets out. But most likely, I think I'm going to try and play this one to the play IBM to the upside and XLK to the downside. All right. Thank you guys all. And if you can't take that, take it easy. Bye for now.